let folks in. Welcome, welcome, welcome.
How are you?
Welcome, welcome. Thank you guys for joining us this afternoon for Eminae CEO Forum. As you're joining, please put yourself on mute. This way we can have a clear call, a clear meeting today with little to no background noise. Definitely appreciate each and every one of you attending. So just give it a few minutes while folks enter and populate. A lot of familiar faces. So thank you for taking time out of your lunch period to join us. Most folks are trying to get out and enjoy the weather, but you guys are here with us today to learn some great information. So appreciate each one of you guys attending. So let's get next 30 seconds or so as attendees populate the room. How's everybody doing? Okay, by show of hands, everybody's good? Good day so far? Perfect. Questions, comments, feedback, there's a chat box. You can enter your information there, any questions for the panel. We have an esteemed panel here that's going to be covering a lot of great information. So I'll allow our speakers to dictate whether or not they want to be interrupted. Some folks will like to engagement throughout the process, and some folks like to keep things to the tail end. So let's give it a minute while a few members populate the room here. And the time is now 12:02, so we can definitely kick things off at this point. So thank you for attending and joining us for our CEO Forum today. My name is Kyle Griffith. I am the CEO and founder of Eminae Network. We started Eminae. We're going on just over 2 years now since we have been providing these forums and educational platforms for business owners and their advisors. I also run a mergers and acquisitions company where I help clients with the purchase and sale of their business. As far as Eminae goes, we are a company made up of advisors that help clients on
so much activity.
Yeah, as you join, if you don't mind, just please put yourself on mute.
Financing for equipment.
Whoever's on, you get some chance. If everyone behaves well, we have a great chance for everyone to network afterwards once we are done. So I do appreciate each and one of you attending today. A lot of work is done in the preparation for these sessions, and I would like to acknowledge our chair of our education committee. That's going to give some context as far as how we go about putting together these events. And he's also going to introduce the speaker. So I just want to turn the floor over to a good friend of mine. So I have a lot of respect for. Most of you guys know Ken Pichelle. He is the owner of Dynamic Business Consultants. He's also on the board for Eminae, and he's the chairperson of the education committee. He's responsible for putting this event together. So Ken, you want to say a few words before we kick things off?
Sure. First of all, I'd like to talk about the committee members themselves and their sponsors, because believe me, I'm helping, even though I'm the chair. But the people on this committee just go above and beyond, and I'll talk about that quickly. But you all know Kyle at NYBB is our sponsor and the best business brokerage in New York State. Triangular Consulting, Roy Pelicano, who will be our moderator and puts in so much work on this committee, and amazing for any type of business process consulting and IT process. Winnie Benjamin, who had a client emergency who could not be here, which is from Stewart Masters, who worked amazingly with startup businesses and culture and helping them get in the right direction. Rethink Wealth, which is Austin, who will speak about as he presents today. Gravitas Marketing, which is Andy Jacobs, who's responsible for promoting these events. And then myself, who's fractional CFO and bookkeeping services. we put a lot of work into these events, from planning, from figuring out topics to hand selecting speakers, to vetting how they're going to present those topics and the format, and planning everything from, turning this into a fireside chat so everybody can interact, to promoting this event to get the results and the attendance that we get. So, I mean, it's kudos to the committee, and we appreciate everybody in attendance.
Thank you, Ken. And just one point I appreciate, I mean, Ken is very humble, but he does a lot of work behind the scenes. We do have some other events that will be coming up, we'll talk about in a little bit. We have roundtable events, as well as our upcoming forum, which is going to be on M&A due diligence for buyers that are looking to purchase companies. In the chat, we're going to populate some information there so you can follow us on LinkedIn and get information on the events. But Roy, sorry to interrupt my friend. Take it away.
No, that's awesome. That's awesome. Thank you. And actually, that is an essence of the Education Committee and M&A in general. Is everybody in this committee and in this group is really humble, and we work really well together because of that, because we all appreciate the teamwork that's necessary. And much of what we do here at M&A is about teamwork. So what we're looking at today is about 3 ways that your business exit can fail and the mistakes to avoid. We all like mistakes. One of our favorite people in the room is Dr. Dan, who does love talking about selling mistakes. And it's something that has reframed the way that I think about how I work with customers. But I know that both Joe and Austin also are in that mindset as it comes to the business exit. So what we're going to be talking about today, in addition to business owner being replaceable, and how do you address the financial issues of business exits, and what your business exit could actually look like in terms of maintaining and sustaining income for you after the exit. Those are things that we will be addressing, as well as actual mistakes. M&A is really a tremendous team that we have pulled together for business owners, as not just trusted advisors, but we are really a full team that comes together. And I know many of us here are part of M&A and part of that network. And I can't begin to tell you how important all of you guys are to making not just each of us individually successful, but the network itself successful. The goal of the M&A network is really to make available to business owners an esteemed group of professional advisors. We're focused on overcoming challenges in our customers' businesses and advising them on how to make the right decision when it comes to growing or selling their business. And it's something that I think all of us truly, truly enjoy. In the sense of, where are we? There we go. In the sense of what we're doing today for our agenda, there's the welcome in the intro, which we just went through. We will then be introducing the panelists and then jumping directly into the conversation. As you know, we don't try to do slide decks. We do have some slides to help with some difficult conversations that we have today, but we're going to go right into the panel conversation, and we're doing something a little different today. There will be 2 Q&A sessions. So the first question and answer session will be after the first portion. Then we will go into the second portion, and we will have a second Q&A. So it is, and we want you to send those questions in. If you send the questions in as we're going through, I will be monitoring the chat, and I will be able to try and get those questions into the conversation. I'm Roy Pellicano from Triangular Consulting. I am a virtual CIO. My focus is really about business process and trying to formalize that and making sure that in the M&A process, due diligence is done around technology and business process. Next, we're going to go to Joe. Joe, if you can say a couple of words about yourself.
Thanks, Roy, and thank you everybody for attending today. I am Joe Milizio. I'm the managing partner of a law firm in Lake Success in Manhattan by the name of Vishnik McGovern Milizio. We have been around for 51 years. I'm almost that long, but not quite. But the firm itself has a very long existence, representing for the most part closely held businesses and closely held business owners in all aspects of legal issues, problems, workouts, transactions, estate planning, and litigation. And Austin.
Great, thanks, Joe. Had to click the mute button on my end. Really great to be with everyone today. Thanks for taking some time to join us, Joe and I. As we began talking about this, I think we've got some valuable things to share, and I hope you get a lot out of it. I'm a managing associate at Rethink Wealth, and our firm works with clients across the country. Most of these clients are business owners, and at its heart, we do three things. First, we do personal financial planning. Second, we do business growth and exit planning, topic of our discussion today. And then we help implement plans. Our perspective is that the roadmap is helpful, but if it just sits on the shelf, it's really an expensive chunk of paper. And so we help our clients to take action around protection items with insurances, conversations with other professionals, and with comprehensive wealth management. As a firm, we manage a little over $1 billion for our clients. And unlike Joe, who has a lot of attorneys in his life because he's an attorney, I have a lot of attorneys in my life. So Roy, if you'll skip to the next one, just because my industry is heavily regulated. But we're excited to be with you, and I'm curious, Roy, if you'll jump over to the picture. Does anyone know what mountain this is? If you know it, just type it in the chat. Nobody. Silence. We've stumped them all. Paramount. All right. K2. K2 is a good guess. Mont Blanc. Everest. There we go.
There we go.
Robert Puerto, winner. I have no prizes to give out, but you won. So this is Mount Everest. And a few years ago, I learned something very interesting about Mount Everest. I grew up in Colorado, been around mountains like my whole life, but I learned that when you got a mountain as big as Everest, like everything's tracked. All the statistics are tracked. And so these two numbers on the screen here, if you'll skip next, Roy, 15% and 56%. In the last about 200 years, the data is a little bit old, but the last 200 years, we've had several hundred deaths on Everest. I think it's just over 200. And of those, 15% died on the way up the mountain, and 56% died on the way down. The balance, I believe, were at some kind of a camp or related events after the fact. But according to the NIH, that's actually a common rule of thumb in climbing, that people tend to die on the way down, not on the way up. And I think that this idea has a lot of truth, and I think it's important for us to kind of grab hold of as we're considering exit planning for a business, because there's a lot of talk, there's a lot of resources, there's a lot of support networks for people who want to start a business or grow a business. And so as hard as that is, people eventually tend to get a business off the ground a lot. But when we look at the numbers for exiting a business, what we see is that 4 out of 5, that's 80% of first exit attempts fail. And we never hear these stories. I I like to think it's because of something that I call survivorship bias, right? Where we hear the good stories because no one wants to talk about how they failed to leave their business. It's not like I don't want to share that when I've got a beer in my hand around the pool or something, right? But our hope today is that, as Roy said, that you guys all get to learn from the mistakes that Joe and I have seen. And so we've got a couple of case studies to share, right? These two sections that Roy mentioned, we've got these two different case studies. And we're going to look at this info. It's all manipulated, so it's not really reflective of a specific situation. We're going to keep people's confidentiality and whatnot. But these are both situations that are reflective of things that Joe and I have seen in the real world. And so we're going to share with you a little bit what those are. As you have questions, type them in. We're going to take some Q&A after the first one and then some Q&A after the second. But I don't think Joe or I mind being interrupted with some questions over the chat box.
Not at all.
So, yeah, Joe, do you want to share the first case study with us?
Sure. Roy, why don't you go right into that?
Okay, just give me a minute to share the screen and get it up and running.
While you're doing that, I will give everybody a more detailed scenario with respect to this business. So ABC Corp is a business which I have worked with on and off for a number of years. They're a dry cleaning business with locations throughout the New York metropolitan area. It does all its dry cleaning work in-house, and it employs over 50 people. The stock of ABC is owned by mom and dad and son. Father and mother live in Florida. The business is operated exclusively in New York, and therefore mother and father are for the most part absent owners. Daughter was brought in a few years ago as a temporary controller when profits started to fall. So father was the original owner of this business. At some point, he gifted half of the stock in the company to his wife, and each of them then subsequently gifted 10% in the aggregate to their son. Son is now the president of the entity, and he's also a director. Mom and dad are the other two directors. Daughter, after being brought in and started going through the books, began to notice some inconsistencies in the records. Over time, she found that there was a line of credit that the business had, but there was no record of the line of credit on the corporate books. Moreover, it was fully drawn on to the extent of $250,000. Neither father nor mother knew about it, and son was apparently very good to himself. In addition to fully drawing down on the line of credit and putting it in his own pocket, he unilaterally increased his salary. He spent corporate funds on his personal needs, and he avoided paying suppliers and avoided paying rent for his various locations also. To make matters a little bit more difficult, daughter, in working there, was approached from many angles by various employees who told her that son, the president, was verbally abusive to many of their employees and that there were 2 discrimination suits pending. Daughter reported all of these incidences to mother and father, who had no idea of what was going on. Nevertheless, aside from taking some preliminary steps, and those steps were essentially to contact me and say, what can we do? And I went through a whole series of steps that they should have taken. The only thing they actually did was say, okay, it's time to sell this business. And what do we have on our hands other than a potential disaster? Well, we have a disaster, but let's look at some positives that were done first, because the negatives far outweigh the positives here. So I indicated that father was originally 100% owner of the business. He subsequently transferred 50% to his wife, who then together subsequently transferred 10% to the son. So they started to do some estate planning here. As business owners, that in my head is number one. You can always plan for the life of your business, but it's very difficult to plan for your business when you're no longer there. So estate planning, first and foremost. And they had some really good methods here. Father transfer to equal out husband and wife's estate, and then mother and father transfer to son to get some of that equity down to the next generation. But then what happened? Well, there are two scenarios for people who start businesses. They get so involved, they have the blinders on, they operate their business to improve it, to grow it, to make sure on a day-to-day basis that it's functioning. And they keep those blinders on for the remainder of their business life. Is it good? Could be good. Is it bad? It could be very bad. And we'll get into that in a few minutes. The other way I see business owners sort of handle the second half of their business life is to totally remove themselves, which is what mom and dad did here. They said, we had enough. We're done. We're moving to Florida. Son, you're a 10% owner. Here you go. They moved. Daughter was working for an outside employer, had no concept, and son was left on his own. So what do we have here? We have a son that went rogue. He just did things on his own accord, did things illegally, committed fraud against the business, committed fraud against his parents, which, by the way, has been happening from what I understand more and more over the past 14 months due to COVID, because people haven't been fully engaged. They haven't been in the office. They've been leaving their children to run their business while they're quarantining, perhaps in another geographic location, et cetera, et cetera. So anybody that's advising closely held businesses should certainly keep that in mind and take a look at the business and how it's being operated.
So
So,
Joe, quick question. From the standpoint of the three ways that we were looking at failure, from leadership, structure, as well as growth, it sounds like this business was really looking at the two failures tied to both leadership and structure. Is that, would you assume the same in that respect, or would you
Yeah.
change that?
you're absolutely correct, Roy. So this business had no plan, nothing in place as far as a shareholders agreement, an employment agreement, any kind of restrictive policies or procedures placed on the son. The parents begged out. They said, okay, we have full faith in you, son. That didn't work out too well. So they totally avoided any planning to make sure that son had the right focus, to make sure that the business was going to at least operate efficiently despite their absence.
And so from that
You-
standpoint of leadership and structure, Austin, what do you see with this use case that we would want to pull in? One of the things that you had brought to
Yeah.
our attention was the concept of the Tommy Boy scenario. Would this be the equivalent to the
Yeah.
Tommy Boy scenario?
There's some hints of Tommy Boy here. You know, I personally love thinking of movies that wouldn't exist if people did planning, and Tommy Boy is one. So if you need a refresher, it'll be well worth it. You know, the thing that stands out to me is that it sounds like mom and dad still needed some money from the business, or else they would have just given away, you know, 100% of the ownership. And so really, it seems like they're kind of bumping up against this issue that they gave away much of the day-to-day control before they had their money. And while they still have legal control as the majority owners, it it's not the most fun or easy conversation to have when you find out that your son is stealing from you. And that slowly but surely, or maybe not so slowly, the business is kind of dying on the vine with potential lawsuits and things like that. So that leadership gap is huge. And that's why, I'm reminded of that question that we had on the flyer, right? Why would you want to make yourself replaceable as the owner? And this is a great example of that, because it's counterintuitive, right? Like that idea, if I own a business, why on earth would I want someone else to be able to do what I do? Does that make me less valuable in the business? And there's some, identity and self-reflection things that are for people who do things, to step into that space. I don't, but maybe we need a coach or a consultant to work through some of that. But really, the more tied the owner is to the success of the business, the less that business is worth and the harder it is to sell it, right? Because if we've got to have you as the owner there after the transaction, that means that you have to be there after the transaction. Like, you can't leave and expect to get full price for it or expect to get all cash. There's got to be some kind of compromise there if you're not replaceable. And it sounds like this family, the compromise they decided on was that their son would just run it and they would get paid. And, I don't know what was happening in anyone's mind beyond that, but obviously that leadership gap really rippled into a lot of subsequent issues.
So
right? Like, their son clearly wasn't ready, whether because of character flaws or lack of training or lack of coaching or lack of oversight or what have you. He clearly wasn't ready to take on the business and be successful.
So you do see, I guess, from time to time, one of the mistakes being made is that the leadership that's been chosen turns out to, once that transfer happens, turns out to be not an effective choice of leadership for some failure point. And
yeah,
I guess what you're saying is, if you work yourself as the business owner out of the business, then you're better able to identify that as a failure point before it becomes a critical failure for the entire business.
Yeah, and sometimes it's even taking the time to do this, especially with a family business, right? Taking some time and giving serious objective consideration to whether or not your son or daughter is the right person to take over ownership. I think we've got to be real sometimes that not everyone is built to own a business. And as much as we want to help our kids, I'd do anything for my two kids, but I also know that if I put them in a situation where it's just not their thing, that's not their strength, I'm not actually helping them, right? And I may be hurting myself, and I think that's kind of what happened here when we look back at how it played out.
And on top of that, Austin, you're absolutely right. But on top of that, would anybody ever suggest to their clients that they hire a president of their company without any agreement, without any boundaries, without any restrictions, requirements, et cetera, without an employment agreement? No, it's never going to happen. But does it happen in transfers to family members? So often.
For sure, right? Roy, the other thing that occurs to me about this and this case study is that, there was something happening there with mom and dad, I think, where they wanted to leave, but they weren't financially ready. And so they started down this road of like compromise, right? We'll make our son a minority shareholder and we'll just still retain 80% of the business or 90% of the business from Florida. That says to me that financially they weren't really ready to leave. Or either that or they had reservations about their son in the first place, or they would have just found a way to give him everything. Right?
Right, because they stopped in the middle of the standard process of transferring your business.
Yeah. Yeah, it's like you're doing a relay competition and you made it to the second person. You didn't keep going, right? Like we just
Right.
didn't finish the race there.
Well,
Um,
I'm curious because Joe, this was actually, I think, a real life scenario that you had. So I'm curious, where was the daughter in all of this, right? I mean, yes, she came in after the fact, but how did she come back in after the fact, and how did that dynamic happen, and what was the ultimate impact of either positive or negative on the parents and the transfer of assets across generations?
Yeah, daughter was really put in a difficult position here, both in attempting to work from a business perspective with her sibling and on a personal level dealing with her sibling, in addition to attempting to let the parents know what son was doing and trying to convince them that it had to stop, but not really getting anywhere with them. So she was sort of a stooge sitting there telling everybody what was wrong in all different directions, but nobody was willing to work with her to implement any change.
So in the sense of how to avoid this mistake, I'll start with you first, Joe, and then Austin will transfer to you. What would be the steps that could be taken to avoid this in a similar situation?
So planning, right? Take the time, start 5 years, better off 10 years before mom and dad want to move to Florida. Sit down, hire the right advisors, make the plan. Daughter was actually, I got to know this business because daughter worked for my firm as an assistant. So she really had full opportunity to come into this business. She had a financial background. She was there, ready, willing, and able. They just never even considered her to come into the business to either operate it on her own or with son, or to plan so that everybody had their own particular field of expertise to grow this business.
Excellent. And Austin, from the standpoint of that retirement asset value gap, I think that's one of the things that we identified. They might have actually stayed somewhat involved in the ownership level of the business in order to address the fact that they didn't plan that properly. So how would you advise somebody who was approaching this scenario so they don't make the mistake?
Yeah, that's a really important question, because I actually see, a lot of times when I'm talking to the owners of a family business, mom and dad, their initial instinct is to do some version of exactly what this family did, right? Where they basically leave, but they retain ownership, or they leave and then they stay on payroll, or like there's a whole series of things that happen there that are all reflective of the fact that they just don't have enough money to actually leave. And so I think it's helpful because I look at this stuff all the time in, my space with coming at exit planning from the financial side. I think it'll be helpful for everybody to get a sense of the actual size of that gap. So Roy, can you bring up the first, I think it's slide 12. A lot of times when somebody goes and sits down with a financial advisor, their advisor will run what's called a Monte Carlo situation. And a Monte Carlo basically takes the good ones, take like 10,000 iterations of actual market returns for actual market like asset classes, and run a scenario to see what the failure rate would be, right? And anytime you think of a failure rate here, especially with retirement planning, I want you to think of yourself taking off from JFK on the way to Paris, and the pilot says, there's this % chance we won't make it. Are you going to stay on the plane? All right. So what we're looking at here, imagine that somebody netted $10 million after selling their business. And we're going to show that, I read a lot. There's a lot of media about this 4% rule. That rule, so to speak, is like 30 years old in terms of the data. We're looking at a 3% inflation scenario in 30 years, right? So this is pretty standard of what someone may run. Maybe they're showing 2% inflation instead of 3%. But you can see with basically a 50-50 portfolio, the simulation failure rate right there on the top is less than 5%. So 95+% of the time, this is going to work, right? They're going to be able to take out 400 grand from their $10 million, adjust it for inflation, they'll have enough money. The issue is that this doesn't account for everything that's actually happening in the real world. Because people say, oh, I'm taking out my 400, that's great, but that's what I need like after tax, right? And in order to manage the $10 million, you're gonna have to pay somebody like me and my firm to help you do that, right? There's always cost there. So go ahead and move to the next slide, Roy. And so when we adjust for that, right? What if inflation's a little bit higher? What if there's a management fee? 1.5, even on a $10 million portfolio, 1.5 by the time you account for all of the trading costs and spreads here. This isn't necessarily what the advisor is charging, but these are the costs that are going to be there. And assuming just a 30% tax rate, right? So we plug in some taxes, look at inflation, look at maybe a little bit longer time period, et cetera. Now, all of a sudden, it's a 93.5% failure rate, right? And so, you know, I think of this couple, mom and dad, they probably knew from the first slide that they didn't have enough, but they didn't realize from how it's actually going to function in the real world that they really, really didn't have enough. And so, you know, from my seat, this means, again, planning. We've got to put time and energy into addressing that asset gap in advance, because rate of return on the publicly traded portfolio here, that's not going to save this, right? The lever that really will make a difference at the end of the day is the finances going on with the business, the value of the business, how much money we're able to get out of the business before they leave. That's what's going to be the difference maker. It's not the portfolio. And so I know you heard it here first, guys. The financial advisor said the investment portfolio won't fix it.
So, Austin, first of all, I'm very disappointed. I have the airplane on the tarmac. When you mentioned Monte Carlo, I thought we were crossing the pond here. I'm a little disappointed.
And that would be fun too.
I'm a little disappointed. So one of the things that we also talked about was the taxation issue and double taxation. So I know that's not tied directly into the Monte Carlo, but how does that also impact what we're doing? And we do have a slide on that if you want me to pull that up.
Give me just a second before we pull the visual up. The taxes at the sale matter, because at the end of the day, when you're selling a business, the money in your pocket when it's all said and done is what counts, right? So, you know, if you sell your business for $10 million, but because the tax structure wasn't very good, and I'm rounding here, but because the tax structure wasn't very good, maybe you net 6, right? That's a totally different scenario than selling a $10 million business and netting 8. Right? And when we're looking at this with a family business and a sale to an insider, we've got a different set of problems with that sale, because, you know, when somebody like Kyle goes and finds a buyer for a business, the buyer is going to deal with their financing, right? They're going to put money into it. They're going to go figure out how to borrow money. And there may be some kind of an earn-out component or something like that. But at the end of the day, the buyer is going to deal with their side of the table, and the seller is going to pay their side of the table, and that's it. And we don't really care what happens so long as the seller got all the money they needed when they left, and it's done, right? At that point, if I'm representing the seller, I don't care about the buyer anymore. The issue with the family business is that you don't have like a professional owner. You don't have funding coming in. There's no private equity firms putting up the cash. And so they're broke, right? Like your kids are broke, your managers are broke compared to you. And by that, I just mean they don't have enough money to buy your business. So let's bring it up, because what happens here is now any tax inefficiencies create a drag that ripples through. And this is especially important when we're thinking about a family business, because it's all family money at the end of the day. So imagine we need, we're selling a business, and the numbers here are just illustrative here, right? So in order to get mom and dad a $600,000 principal payment, the buyer, the kid in this case, right, the son, would have to earn $1 million, right? Earn $1 million, pay tax at 40%, give or take, right? And then they now have an after-tax $600,000 to pay to the seller. Well, the seller has to pay tax on that, right? And we're not really counting anything at the state level here. So imagine if this is New York, right? We're adding and inflating all of these numbers. Now the seller is netting $480,000 when the business had to generate $1 million of cash flow. Like the business had to have $1 million of profit for the seller to end up with 48 grand or 480 grand rather. And so anything that we can do with planning for the second generation to take over in a way that makes this tax picture better becomes a very interesting conversation, right? You know, what if it was possible for the business to earn $1 million to get the seller like $600,000? That would be more attractive, right? And there are ways that we can do this when we have time to structure the transaction. Because if you remember the scenario, mom and dad gave their son ownership of the business, right, to give him some skin in the game, but they still needed money, right? And why didn't they sell it? Well, probably they didn't know how to deal with this, and a bank wouldn't loan their son any money. That's why they didn't sell it, right? Yeah, this is one of those things that often, I don't know, Joe, I don't know what you see here, but often this is like the initial draft of how a sale to a kid or to a manager is going to work. And I think it's more often than not a terrible plan that people should not do.
Yeah, absolutely, Austin. And even to take it one step further, that purchase price, the $600,000, whatever the purchase sale price is often payable in a promissory note, right? And how often does a kid come to parent and say, I know or maybe not even say it, I know I have a note payment due, but I just can't swing it this month. Or maybe they just don't make the payment and don't say anything and wait for parent to never say anything either, right? So therefore, the value is gone, and one payment goes into 2, that goes into 12. So that doesn't work very well either. And what people really don't look at in family transfers is the ultimate potential estate taxation also, and what to do with that and how to maneuver through that. And it sounds very counterintuitive, but when you're dealing with transferring a business to family members, you want to try and keep the value as low as possible for estate planning and estate tax purposes, and even for that matter, income tax purposes, right? So you want to keep it low, but then where do the assets come from? Where does the money come from? Mom and dad need the cash. They left the business and said, okay, son will do whatever he's going to do and send us a check once a month. That's not happening. And they didn't plan accordingly to get anything over more than that 10% to son, because they were concerned about the cash flow. The thing that everybody should consider, and you'll probably agree with me in a second, is to increase the cash flow before the transaction actually takes place. So mom and dad can pull whatever they need out of this business before they have to worry about son failing in it, for lack of a better term.
Yeah.
And we actually
It's
had
like
a
the same-
question about that, so I am going to jump into the Q&A section, but I did get a question about that. Really what you're talking about there in some respects is trading current certainty for future uncertainty, and also that the seller retains risk even after they've sold the business. And so it's not
Yeah.
really for the older generation, it's not really actually a beneficial transaction. And even throughout the generations, it creates a lot of risk and failure. So would you guys agree with that?
Absolutely.
Okay, cool. I know we do have a question from Ezra, but actually, Ezra, I'm going to save that for the next case study, because I think it fits perfectly into that case study better than this one. But do we have any other questions?
Roy, we got a question from, a comment from Shelly Miller, and saying this might be a good opportunity for ESOP, a worker cooperative. Shelly, you want to come off mute and ask a question or make a comment directly?
Yeah. I wondered whether or not the option of selling that business to a broad base of employees, that would be one way of dealing with many of the kind of difficulties that the mom and pop had in trying to find a seller. And they had a nice number of employees, so they'd have the option probably for either. Although at 600,000, probably the worker cooperative would be best option for them, because there's special financing for that. So a lot of the issues that banks won't do, they could have gotten around. I mean, they might have had to maybe finance 30%, but at least 70%, they could have walked away with cash. So was that something looked at?
Well,
Joe, do you want to talk about like which options they were looking at before you met them, I guess?
yeah,
This was all before.
So they really didn't look at any options in making this decision. Their sole thought process here was, we have to provide for son, because son needs to earn a living, son needs to do well with his life. Parents did pretty well with this business when they operated it, and parents thought they were giving that benefit to son as well. However, son turned around and proved that he couldn't manage this business.
Yeah. And I think, that brings up an interesting idea here too, is honestly, there are situations that could come up, and maybe they should have looked at the daughter as an option, but there's situations that come up where you've got a family business and the best answer really is to just sell it to a third party, or, Shelley, the idea of ESOP or a cooperative, that's a path that maybe makes sense to explore. But you still have to, this family would still have to address all these same issues, right? They need to make sure that they get enough money out of the business, that there is successor leadership in place in the business before they leave, who are going to be able to run the company. That's almost more important if they're selling to an ESOP or a cooperative than if they're selling to a third party, honestly. And then they've got to make sure that they're netting enough from a after-tax perspective, right? That the structure is attractive.
Can I just make the comment that those issues are actually addressed in that process? Because it's like a process that, you go through, like my organization worked with, and especially the first two. And, the first thing we do is sit down and do goal setting. What are the goals of these owners? What are the financial needs or goals? What are the non-financial needs and goals, which a lot of times you can't address with any third party. But in these kind of deals, they get to structure it. So they have a son who's in the business and a daughter that's out. There's a way to structure it where the son stays in the business, where the son has a particular role. But because there are other people there keeping an eye on things, like he can't just be randomly taking out money and spending it any way he wants. So
and I think this goes back to the core issue of the three, the the three things that really need to be in place for any good transaction and transition, which is the leadership, the structure, and the growth to support everything, which goes right back to having the ability for the business owner to step out of their own business and not be tied directly to it, right? If you need to, some of the comments about employees is whether employees actually have the skills to be able to take over the business, whether they can afford to buy the business. And if proper planning has been put into place, I think the many of the concerns that might be addressed are, many of the concerns that might be posed are addressed. And it's really about trying to identify then what's the best way to execute this, as opposed to coming up with obstacles, because you're focused on those three key structural pieces, which is the leadership,
Yeah.
the right structure, and the growth. And I just want to bring
Yeah,
one
and
thing
Roy-
up, Austin, before you jump in, is
Okay.
someone sent me a message about whether pulling the cash out by the parents, does it potentially increase the personal tax exposure while reducing the value of the company transferred to the son and the daughter, thereby reducing future basis for the son and the daughter when they sell it. So two things.
Got
there,
it.
but
Yeah. So let me make the first comment first. So my thought on the same line of thinking, Roy, about what's involved here as you're thinking about the family business. It occurs to me that sometimes people can conflate benefiting from ownership with in a business with running the business, and those can be separated. And the larger the business is, the more true that can be. So, like, I think of Coors. Coors, by the way, is a family-owned business. I don't know what generation they're on now, but I think it's like the 5th or 6th generation. And they have, I think, 0 family members employed by the business. They took it upon themselves long, long ago to hire professional executives and managers to run the business. And then they benefit now just as shareholders and from the profits of the business, right? And so there's a point where a lot of options exist. And Shelley, I love what you said earlier, start with the goals and figure out from there, because that's exactly what I do and what I'm sure Joe does in his process. It's just that a lot of this depends on what the owner does, not on the advice that we give them, right? And then second on that thought, Roy, around, now I've lost it.
it was about
reducing the ultimate value.
Right, the ultimate value.
Yeah. I'm going to oversimplify things in a way that anybody who's a business appraiser is not going to like. But at the end of the day, the value of the business is mostly dependent on ongoing profits and cash flow. And so it doesn't matter that mom and dad are going to just take the profits out. As long as you're not negatively impacting the growth trajectory of the business or the ongoing profitability of the business, that'll be fine. And generally speaking, each generation is going to be responsible for their own basis and whatnot, at least in the law as it stands today. Why don't we jump to the next case study, Roy? Does that?
I think it should be shared already.
Okay, awesome. I see it. Thanks. So there's this is representative of some businesses that I know. Again, some details changed here. But this business actually was in the 3rd generation of ownership, and it was run very well. It was a big manufacturing business in the New York metro area, and sales every year, top line revenue was over $40 million. But the daughter, actually, this 3rd generation, she was running the business mostly to step in because there was some issues that came up with the family, and she was doing it to take over when her father became unable to. And her goal had never been to run the business. She was very good at it, but it wasn't what she wanted to do. It's a highly specialized industry. They manufacturing very specific parts for very specific components for like governments. The issue really was that the management team wasn't really trained to run the business. The labor was skilled labor, and they were all good. The managers didn't make anything; they weren't actually on the floor. But you had this scenario where it was tough to find the right buyer with all of these pieces falling into place. You needed somebody who knew the industry, who already had government clearance to deal with the things that they made. And it's just a lot of moving parts. So not anyone was going to be able to come here. It really narrowed down your pool of potential buyers. Okay. And as any business broker or transaction intermediary will tell you, the smaller your pool of buyers, the more challenging that sale could be, right? Just less competition. Before this granddaughter had taken over, her parents actually tried to sell the business, and it fell through, right? A lot of these pieces that had to come together with operationally, who would stay, who would run the business, the clearances, all these pieces just added up to be way too much. And so the buyer kind of was fed up with it at some point. It wasn't enough money from the seller's perspective. And so it all fell apart, right? This is one of those examples where you've got a business, it runs well, they make a ton of money, they're doing great, and they couldn't sell it, right? And a lot of that was because they hadn't planned for anything. They were just trying to throw all the pieces together while they were talking to this prospective buyer, which was a strategic competitor. Well, fast forward a few years and things had changed. And operationally, there was more support. Now that mom and dad had begun to step away and the new generation come on, she didn't want to deal with everything the same way that her parents had. And so there was better management, and profitability had actually nearly doubled over the 3 years or so that she owned the business, which is a phenomenal trajectory there. And so one of their largest competitors, slightly different relationship, ended up making an offer, and it all surprisingly to me a little bit, because they didn't go through all of the planning that we probably would have preferred, but it all just worked because of how much the seller wanted to leave and how much the buyer wanted to purchase. So any point where there was a potential conflict and a potential just, moment of failure, both of them wanted the transaction to happen so badly that they just figured it out. And that's not always the case, right? Usually the buyer is not that committed. Usually the seller, there's something that happens and it would fall apart beforehand. So this is an example of, I guess, a first-time failure and a second-time success. So second-time lucky, as they might say.
And isn't that often the case? I mean, I think one of the things that you've quoted to me multiple times is that the majority of these deals fail on the first attempt, and it takes 2 or 3 before a sale finally goes through.
Yeah,
and I think maybe both of you guys have seen that. One of the things that the reason why I asked Ezra to hold his comment till this one is because he was asking about, in essence, breaking the company apart and over time selling the company as pieces and business units, and therefore you might be able to take a company that might not have a successful exit and sell, in essence, the assets off of it. So do you guys see that happening as well? And is that a potential solution if you don't have such a strong leader as this third generation was?
Most of the businesses, quite honestly, that I deal with are closely held businesses and don't have the luxury of having various subsidiaries or various aspects of their business And quite honestly, the owners don't have the wherewithal to say, okay, I can take this segment of operations and spin it off and sell it or deal with it effectively on its own. But that being said, yeah, that could be a very pertinent way of at least sticking your toe in and testing to see what will happen, particularly if the transfer is or to an insider. It gets them sort of in track or online for operating a business, but not necessarily the entire business. The other way of doing it, of course, without segmenting, is to have something like a family limited partnership where the original owners still maintain control, voting structure, et cetera, and the new people coming in have the incentive to operate the business and grow it.
Yeah, Joe, it occurs to me, I think normally we would see that kind of structure in a large publicly traded company, right? Where you're going to do a kind of segmenting the business. The one area where it could be interesting is, and I think you sort of alluded to this, is as actually a tool for leadership development. And so you wouldn't necessarily segment the ownership, but you could, one of the things that I've seen work really well is you set up these benchmarks for a leadership progression, right? So for example, if we're thinking back to when the son could have been buying the business over time, right? Yeah. You know, maybe that's occurring over 4 or 5 years for the son to own 40 to 45% of the business. And you give them a goal for each year and say, this year, we want you to be responsible for this. We want you to accomplish this. And if you do those 2 things, you will have the opportunity to buy 10% of the business from us. If you don't do those 2 things, you don't get to buy, right? So it's these hurdles to ownership that are also tied to leadership development. So I've seen that work. You know, I've also seen where you don't have necessarily, you know, and this is more reflective of the second business, where you're going to have people who are not in the family that are running different departments, essentially. You know, we need the sales department to run a certain way. We need the manufacturing to run at a certain capacity and efficiency and quality. And so maybe, especially for the non-family owners, we've got incentive plans set up for all of that, right? And so I like to say that a lot of times these are what's called non-qualified deferred compensation plans, which is its own mouthful. They're highly effective though, and you can carve out an individual manager to set specific goals, right? So I'm working right now with a business that's just hired a new basically VP of sales, and there are targets for the total production and profitability. And if the new VP hits those, then there's going to be this award that is very sizable compared to his base salary, but it's also deferred. And it's vesting. So he doesn't get it day one. He gets it in like 10 years. It's just, he earns it day one, right? And then, but if he leaves or if he tries to take customers with him, he doesn't get paid. And so it's in a picture, I like the pictures. It's like if you're the business owner, your business is your ship and you're the captain, and you need all of your employees to row harder, faster, and not jump overboard in the middle of the ocean. And so that's what any of those 2 strategies could do, right? Like either that transition with leadership to your kids, or these developmental goals for a manager. Maybe it's even a manager that you want to be your successor owner, and you've got some kind of incentive set up like this to retain them, motivate them, and help to equip them so that they'll be able to buy when it's time.
And those compensation plans can include a structure such as a non-qualified stock plan, so that you still have the vesting, you still have the forfeiture. If the employee leaves, they give up their ownership. You still have the drag along rights, so that if things don't work out and they don't meet their performance standards, the owner still has the right, or the majority owner at that point still has the right to sell the business, and the participant in that option plan has the obligation to sell as well. So it can give some skin in the game as far as ownership is concerned, with the original owner still being protected in case things don't work out and they have to seek a second opportunity.
Yeah, and with all of those, I love the restrictions that you talked about, because somebody from Eminae said this in a small session once. It's a lot easier to get married than it is to get divorced, right? So these hurdles in regard to getting ownership in a business, whether it's for your kids, a manager, or somebody you've never met, having benchmarks there to just say, this is what I want to have happen. These are the things that I need for myself, or I need for my business before we go down this path. That's hugely helpful, right? You want to take a slow path to marriage, because then you don't have to deal with all of the issues of problems and
Unraveling,
business divorce, right? Unraveling it.
So I think, one of the things, I think many of the things we've discussed go back to those three critical pieces, planning, which is both a leadership and a structural quality. If you have the proper planning in place and you do it in time, then you're not going to succumb potentially to the likelihood that the transfer fails on the first time, or creates a greater risk after the transfer for the seller, and even potentially a greater negative impact on the buyer in the sense of the taxation issue. What I love about what we identified is that insider sales, which are about 50%, I think, Austin, you gave me that number, are about 50% of all business transfers. And ironically, they're also somewhat the most risky. And I think it's because of these three qualities, these three key issues that are not really addressed, right? The idea of structure, leadership, and growth, and having the right pieces in place for the transfer to occur. I want to thank both of you guys. I don't know if you have any last comments before you want to jump off, or if we have any last questions, but I just want to say that we're going to wrap up and go into the networking in the next 2 minutes.
I would just want to close with the proviso that the structure of the transaction, the underlying structure of the transaction from a tax perspective, is equally important, as important as all of the other things that we've been talking about today. So many people come to me and they say, okay, I want X for my business, and after taxes, I'm going to end up with Y. But Y is so unrealistic, because they don't really know the intricacies of how the tax implications will affect them, because they haven't bothered to actually sit down and go through it with a competent advisor who's going to tell them, okay, well, if, for instance, you're selling your assets, those assets are specifically classified into different categories. And the taxes that you will pay based upon the sale of those assets is going to differ substantially based upon the assets that you're actually selling. So it's not just okay, if I'm selling for 10 million, I'm going to pay 3 million in taxes and I'll end up with 7 million. It's far more complicated than that.
Yeah. And the devil's in the details here. Like, that's the thing that occurs to me, is the devil's in the details and what people don't know as it relates to their planning for their exit. I think, I know some of us on the call are advisors to businesses. Some of you guys may be owners. But the other thing that occurs to me that I think we just need to watch for over the next few months is what the impact could be of any tax code changes that come down the pike from Congress. The proposed legislation as it stands at the moment is just going to make leaving a business much harder and much more expensive from a tax perspective. But I think the people who pay the most in taxes are going to be the people who don't plan and who try to get it all done at the last minute, because there's going to be tools and techniques that an exit planner and your advisor team will be able to bring to the table to help mitigate that. So start early. And then lastly, from where I sit, exit planning is a team sport, right? You know, I'm a financial advisor. I do exit plans, like I create them for clients. They hire me to do specifically that, but I'm not an attorney, right? So we need somebody like Joe to come in and look at all of the legal aspects and what the best techniques are. I was on a case just the other day where I brought in the attorney to start talking about the transfer with a gift strategy to the next generation of a family business. And the attorney had an awesome idea that I hadn't thought of, right? And so with all of these things, more people in the room for the business owner on their team is going to make everything better, generally speaking. And somebody other than the business owner needs to be the quarterback. Otherwise, it's like somebody trying to figure out how to build their own house as an architect when they're not an architect. They're not a general contractor, but they're just trying to hire everybody off of Angie's list.
So do we have any?
Maybe the house gets
questions
built,
at this
but it's
point?
going to be
Austin,
pretty stressful.
Austin, I want to jump over to questions so we can wrap it up and get over into
Sure.
Get over into the networking. So I did put a thing in the. Anyone have any questions? Okay, Kyle, are we ready to jump into networking?
Definitely, guys. Great, wonderful presentation. You guys, I think you guys pretty much nailed it. Preparation is key, and making sure you have the right advisors is paramount. I have been involved where we have done some bifurcated deals where we actually split companies up for different purposes. And I have a client I'm working on right now where we may actually split as a manufacturing company, where we may actually split the company up as well. So anything you can do to help the client out with their tax situation or helping them make sure they can maximize the value of their company. For those of you that stuck around, the bonus of sticking around, you get a chance to connect and make some new friends and get to meet some of the members of our team on M&A as well. So we're going to open up some rooms. There's going to be about 4 to 5 folks per room to get a chance to stick around and meet some of the people here that are in attendance. Just want to note that our next forum is going to be on June 24th. And is Kirk still with us? Kirk, I see you here. Do you mind, are you around? You mind jump off mute and giving folks a quick overview? So Kirk actually has a family office. He's in the process of looking for opportunities, and he has a lot of experience reviewing deals. So Kirk is going to be one of our speakers for our upcoming forum on the 24th. And Kirk, if you're around, do you want to jump off mute and introduce yourself and give folks a quick overview of our next event? Okay, maybe he stepped away. Anyway, so we're going to kick it off. We're going to have a 10-minute networking session. Be sure to save the date for June 24th. And we also have our roundtables, which is more of a smaller group, intimate setting. The next one is going to be on June 2nd. And we have an estate planning attorney that's going to give some insight on how to prepare your business for an exit from an estate planning standpoint. So thank you guys for attending. We're going to open up the rooms now, and happy networking.